Good morning, everyone, and thank you very much for joining me. This is the morning market review with myself, Russell Shaw. I'm a senior market specialist at FXCM, and what I'd like to do is go ahead and bring up the disclaimers before we get into the live stream. Just in terms of date stamping, today is the 15th of February. Let's go ahead, bring up our high risk investment warning. Good morning, Raj. As always, it's a pleasure to have you on the webinar. I'll just keep this high risk investment warning on screen for a few moments. If you can just take the time to have a read through that. I'll just keep it on for another few seconds. Let's bring up our market commentaries disclaimer. If you can just have a read through that as well. All right, terrific. All right, what I'd like to do is just go through the NASDAQ. The reason I want to go through the NASDAQ is because we looked at it yesterday, and I just want to do a debrief, so to speak. I think it gives a pretty good idea of the methodology that we use, and I think it's going to be very useful. Hey, Mia, good morning. Hey, Kim, good morning to you. Welcome both to the live stream. As always, pleasure to have you. All right, so the idea here, I just want to do a debrief. Yesterday, we looked at the NASDAQ, and I just want to go through what we saw yesterday in terms of the signals. And all right, we're starting off with our weekly chart. Okay, we're starting with the weekly chart, and where is the NASDAQ positioned relative to its 30-week exponential moving average? And it's above, and the 30-week exponential moving average is moving in that northeasterly direction. Where's the RSI? RSI is above 50, so there's a positive momentum. We're pretty close to being overbought, but we're not there yet. I'd say tending towards overbought, but we're not quite there yet. And what we want to do now is we want to just check the daily chart and see if the daily chart has some sort of synchronicity, if it's synchronized with the weekly chart. So let's go ahead and bring up our daily chart on the NASDAQ. All right, so this is the daily chart. This diagram that we drew in, this kind of dip in the uptrend, is exactly what we are looking to do with regards to our methodology, right? We're looking for dips in the uptrend. Let's just change that circle to a black circle. So kind of we're looking for that dip in the uptrend. So the zone analysis showed us that we moved from zone 1, the bullish area, that's between the upper blue and the upper red. It pulled back down to the neutral area between the two blues. So we're looking as of yesterday, when you and I spoke 24 hours ago, and the question was posed: are we potentially having some sort of dip in the uptrend that we can take advantage of, some sort of dip in the uptrend which we can exploit? So what we did next is we went down to the hourly chart and we looked to see if there was some sort of timing signal in the hourly suggesting a dip in the uptrend. So let's just share the hourly chart, and here is 24 hours ago. These circles we actually drew in yesterday's live stream, and you can see that the 5-hour green exponential moving average is crossing above the orange 10-hour, and you can see that the stochastic is moving in that northeast direction. So there's the two signals. It's a dual signal system. And then, of course, in order for us to be successful, there has to be some sort of swing, and that is generally represented by the stochastic moving to the upper quintile and holding. It wasn't quite textbook because it did go in to the upper quintile and then it fell out before resuming again. So if you just take a look, it went into the upper quintile, fell, but then went back in. But we got a really nice swing here. So this is exactly the type of setup that we're looking for. So how do we play? Hey Anna, nice to have you on the webinar. So how do we play the Nasdaq? Well, the signal was given yesterday. Okay, in order for us to profit off some sort of long position, assuming we want to go long, right? Some people might want to short you. You know, whatever you do, just make sure that you're subscribing to a tested trading plan. But the idea here is, if we're going long, which for me would be lining up with the higher time frames, that would only work out if the stochastic maintains. The stochastic now, it's all about the stochastic now maintaining in that upper quintile. If we maintain in that upper quintile, then we've got the underlying momentum. Just as an aside, anybody that's looking to short now is very dangerous. You're shorting into momentum. Okay, you're shorting into momentum. So just bear that in mind. Let's take a look at the DAX. Okay, just to see how the European side of the market was behaving. We'll do a top-down analysis. Then I want to take a look at the real rate. Okay, so let's just take a look at DAX first. Similar analysis, top-down analysis here. Okay, so I'm just going to bring up the FXCM DAX CFD. All right, so this is the DAX, and this is interesting. Actually, what we can do here, just to make a point, I think it was 2 sessions ago, Anna asked if we should introduce the stochastic. I'm not sure if it was 2 or 3 sessions ago. Let's do that again, Anna. Let's just bring in the stochastic here. So just click on indicators, and let's bring in the stochastic. And I think that your suggestion, Anna, actually was a remarkably good suggestion. Now that we can kind of see that there is some sort of upwards momentum. In other words, when we take a look at the stochastic, and I've actually got the stochastic, this horizontal dash line, that's actually 70. It's not, I usually use an 80. Let me just fix this up. This is not usually the settings. Let me fix this up. That's better. That's better. Okay. All right. And let's just move these from 70 to 80 and 30 to 20. Yeah. All right. That's better. That's better. Okay. So the idea here is the stochastic is in that upper quintile. As long as we maintain in the upper quintile, there should be some sort of support. The key here is it's got to maintain in the upper quintile. If it drops out of the upper quintile, we're losing that momentum, right? Hey, thanks, Raj. Appreciate that. So well, if it's holding, we can see we're starting to move up. Just so we had the last 2 weeks. The last time we tackled this, we said the last 2 weeks were just very ordinary, uncertain candlesticks. We had a doji followed by a doji. It's like, well, what's going on here? There's just nobody wants to take the market up. Nobody wants to take the market down, and we're effectively moving sideways. Well, this week there is some sort of movement. It's still quite a short real body. So it's a short real body. So there's still work to be done here. There's also a work to be done here. But there is a little bit of a buying tail that's starting to emerge, and that's after we've got this positive reference candle. Here's the reference candle, and here's the conclusion of the reference candle. Remember, there's three conditions. What's important about reference candles is that they are typically the start of swings. They don't not if you've got a swing, you'll have a reference candle. If you have a reference candle, you won't necessarily have a swing. That's where the difficulty comes in. But we're starting to pick up here quite nicely. All right. So if that's the case, and you can see the RSI is also above 50, moving along nicely. Let's go down to the daily just to see if there's some sort of synchronization there. And yes, so this is interesting. So this is very interesting. There are big layoffs in Germany. It's not only layoffs. Of course, that is a metric. Generally, Anna, the macroeconomics of Germany are not good. The growth's not good. The PMIs are not good. It's no wonder that there's layoffs. So the idea is, well, okay, wait a second. If there is no sort of good macroeconomics, why is the DAX being supported? So I think that the explanation for that, Anna, is that the market cap, the global market cap of risk, is held by the US well over 50%. Okay, and that's got this because of globalization and cross-border transactions, etc., etc. Given the fact that Germany is largely an export nation, the global nature of sentiment is benefiting companies like indexes like the DAX. Where perhaps it would be quite different is when we take a look at, say, the forex or the currencies. I think the economics may be reflected there, which we can take a look at. But in terms of the sentiment and the risk sentiment, we definitely risk on here, aren't we? And if you take a look at the DAX zone analysis, let's just see if there's some sort of synchronization there. Okay, so let's just go ahead, bring up the zone analysis, and I think we're going to have something quite interesting to say here. I'm just going to go ahead and share that tab. I want to just zoom in slightly more. Okay, that's good. So the support level is holding. That's when I say the support level, I'm referring to this line study here. The fact of the matter is we saw the DAX move into zone 1, and then we saw the Bollinger's expand, and then we saw them tighten. And that tightening of the Bollinger's is like, oh, what's going on here? Are we expanding in volatility, or are we contracting in volatility? What's going on? So there's still some work again to be done. The ambiguity is there, but we are moving from zone 2 to zone 1. I think that is a positive. We can see that the RSI is above 50. I think that is a positive. Okay. And what we can do is we can put in a trend line here on the RSI. And this is going to be really useful for us. Let's just change this to a black trend line. I just think it's easier for us to see. I want to just check the metrics on this RSI. Yeah, that's fine. And what I would like to see here, guys, is I'd like to see the RSI actually break above the downtrending trend line. In other words, yes, we're over 50, so that's great. But in a break above the trend line, I think would just show that there is an expansion in that positive volatility, just at a time when we're moving from zone 2 into zone 1. So if we're moving from zone 2 into zone 1, I think that's positive. Let's go down to the hourly and see what's happening. And are there any signals on the hourly that is worth taking notice of? So let's just go ahead and bring that up. Okay, so I think this is a difficult chart to analyze today. I think it's a difficult chart to analyze today. Okay, you should be able to see it on screen now. Why is it a difficult chart to analyze today? Because the signal was yesterday. Just like the Nasdaq signal was yesterday. In other words, the dip was yesterday. You can see that the movement up was here is trigger 1. Here is trigger 2, and then we got the swing. See the momentum here? We got the swing. So what's going to happen today? Well, if we drop out of the upper quintile, then we're losing the momentum. Then we'll get the pullback. But if we maintain that upper quintile, then the DAX maintains its positive swing. So you can see that when the signals occur, we've got to have a plan of either acting on those, or if we're not going to act on those, have some sort of trading plan that works with your particular trading psychology. Every plan's got to have risk management, which includes money management, it includes stop losses, etc. So yesterday is when the signals occurred. Okay, let's just take a look at the real rate. I'm just going to bring up the real rate here, and there is quite a complex pattern, I think, emerging. I'm not sure what you guys think about this. Here is the movement because of the CPR. I mean, we had basically we had almost a 4.5% move with it, and we've got this big long candlestick here. And now we can see that the real rate is showing some signs of moderation, but the truth of the matter is, and this is where the complexity arrives, is that the length of Tuesday's candlestick is so long that yesterday's and today's red candlesticks are actually taking place within the range of Tuesday's candle, and that to me just adds a complexity. It's hard to get a directional bias there because they're all inside days. So we're just going to have to carry on watching it. What would be interesting, of course, is if we get the real yield to push below Tuesday's low, but because we've got this very long candlestick here, it makes for a very complex situation. So we're just going to have to see how it unfolds. I'm just reading Raj's comment here. Okay. All right, Raj, have a good one. We'll see you tomorrow. All right. One other chart I think is worth taking a look at. I want to take a look at pound US dollar. So we're moving really from the risk markets to a completely different class. We're going through to currency foreign exchange. The reason I want to look at pounds, just because the pound yesterday had inflation data, and today it had GDP data. The inflation data yesterday also showed some sort of moderation, and the GDP data today came in softer than expected. Let's just see what's going on with the pound US dollar. All right, so let's go back to our weekly charts, and let's just bring in the cable pair, and I'm going to go ahead and share that screen. All right, so it's interesting. I mean, there's not much that's jumping out at me right here. This is a weekly chart, and over the course of the week, this is the weekly chart. You can see that cable's come down to its 30-week exponential moving average. The key question now is, will the 30-week exponential moving average hold? And where are we in terms of our RSI? We're actually at 50. So we sort of neutral. and the stochastic is starting to lose some sort of momentum there. Let's just see how we're looking on our zones. Where are we in terms of our zones on the cable chart? And we're going to be looking at the daily. So let me just bring that up for you guys. Okay, so this is interesting. This is interesting. So the daily chart is weak. Why do I say it's weak? Well, we're in our weak zone. As per the Bollingers, we're between the lower blue and the lower red. In terms of peak and trough analysis, just as an aside here, if we've got a peak here and a trough here, so these would be our references. We would have a lower peak here, so this is where some sort of weakness is starting to manifest. But we would really need to take out this. We would really need to take out this low here, the previous trough. So then we'd get a lower peak followed by lower trough. Then we'd move into a downtrend. Nevertheless, according to our methodology, we are in zone 3. We are in zone 3, and not only are we in zone 3, we've got a negative momentum. The momentum's below 50. So if we've got this negative momentum and we're in zone 3, is there any signals that we can see on the daily chart? Let's just go through to the daily chart and see if there are any technical crossovers there. Trigger 1, trigger 2. And this is an interesting chart. This is an interesting chart. So what you can see here is the inflation miss yesterday. Okay, and here is the GDP miss today. And what we've got here is effectively a one. Let me just do that again. 1, 2, 2, 3. So it looks like we've got a rally and a downtrend. And if we do, then potentially this is exploitable. How it plays out is anyone's guess. That's why we use risk management and money management. But we do have a negative crossover. We've got the green 5-hour exponential moving average crossing below the orange 10-hour exponential moving average. So we've got a trigger 1 to the downside. Then the stochastic is crossing over. That is a trigger 2 to the downside. So we've got the two triggers. Is this going to pan out into something that is going to be useful as in a downward swing? Well, that would only be if the stochastic makes its way down to the lower quintile and holds. And if we get down to the lower quintile and we hold, then we potentially get a swing. Okay. One thing just to perhaps take a look at is, let's just go back to the daily chart here. I'm just going to share this daily chart. And what I'd like to take a look at is the spread difference between, let's take a look at the 2 years, and then we'll look at the spread difference of the 10 years. So what we'll do is we'll just go through to the British 2-year gilt. Okay. And what we want to do is we want to get a spread between that and the US 2-year. And the 2 years are pretty short in terms of duration, and are pretty good proxies to what's going to happen with regards to monetary policy. Let's just take logarithmic off here. Okay, so you can see that the monetary policy does suggest that the Bank of England perhaps a little more dovish than the Fed. How do we know that? Well, the spreads dropped into zone 3, and we have crossed below 50. Let's just take a look at the 10 years. See what's happening with the 10 years. Yeah, you can see it's pushed right into zone 3. So what it really comes down to now is when we go back to the hourly chart, if the spread is telegraphing, if the fixed income market spread is telegraphing weakness in the cable pairing, we need to get the stochastic down into that lower quintile, and it needs to stick. I don't know if that's going to happen. That's why we use that our risk management. So just bear that in mind. Okay, that's where we're going to stop for today. I hope that you guys found this useful. If you did, may I please request, I beg your pardon, that you hit the boost button. Just helps me disseminate the live streams, but only if you found it useful. And if there's any questions, you can go ahead, type those in now. Okay, nothing coming through. Let's conclude at this point, guys. Have a great day, a great evening, and please join me again tomorrow, and we'll do it all over again. Thank you very much, guys.